Welcome back to the Deep Dive. Today, we are cracking open the latest financial results from M&T Bank Corporation.
Yep, specifically their full year and fourth quarter 2025 earnings, which just dropped on January 16th, 2026.
And this isn't about just reading the headlines. We're going to get under the hood here.
Mhm.
Our goal is to, extract the core performance indicators, really understand what drove their Q4 revenues and expenses, and I think most importantly, analyze the true health of their loan book.
That's the mission. For you, the listener, this is the roadmap to what actually matters. M&T is a fascinating case study
Why is that?
because they consistently pitch themselves as this ultimate bank for communities, a real relationship-focused institution. But then you look at their metrics, and they show this incredibly robust, almost aggressive growth.
Right, so there's a tension there.
There is.
Yeah.
And we need to see how they manage that balance, especially when Q4 threw some complex, non-routine operational items their way.
Yeah.
So let's start with the big win. What did the full year 2025 tell us?
The full year 2025 was, a performance for the books. Looking at the JAP results, their bottom line just surged.
It really did.
Diluted earnings per share, that core measure of profitability, it increased a stunning 16% year over year.
16%.
Yeah, that's moving from $14.64 in 2024 up to a hefty $17 in 2025. For a bank of M&T's scale, that kind of double-digit growth is exceptional.
Exactly. And that translated directly into their net income, which rose significantly to $2,851 million. That's up from $2,588 million the year before.
Okay.
And two metrics that speak volumes about effective management. First, their return on assets, or ROA.
Right. How efficiently they use their assets to make a profit.
Precisely. That improved 12 basis points year over year, hitting 1.35%.
And the other one, net interest margin, or NIM, the difference between what they earn on loans and pay on deposits, that also expanded, right?
It did, by 9 basis points year over year to 3.67%.
I want to just pause on that term basis point, or BPS, for a second. We're going to use a lot.
Good idea.
For you listening, just remember that 100 basis points equals 1 percentage point. So a 9 BPS increase is nearly 0.1% rise across a multi-billion-dollar book. That's a huge amount of efficiency gained over 12 months.
It speaks to really successful asset liability management across the whole year. And if we filter out some of the noise...
You mean looking at the non-GAAP numbers?
Exactly, the net operating results, which exclude the unusual non-core items. The underlying business strength is just as compelling. Diluted net operating EPS also increased 16% year over year, landing at $17.20.
So their success wasn't just some lucky one-time sale or an unexpected fee. It was built on real operational excellence. That's reassuring, isn't it?
It's more than reassuring. It demonstrates control. Look at their efficiency ratio.
Lower is better.
Always. It improved from 56.9% in 2024 down to 56.0% in 2025. That's operational leverage in action. And for any investors listening, tangible book value per share shows solid 7% year-over-year growth, hitting $117.45.
So this is where we can connect those really sharp financial metrics back to M&T's whole community identity.
The earnings materials, they heavily emphasize their purpose to make a difference in people's lives and their mission to be a bank for communities.
I usually treat those kinds of statements with a bit of skepticism.
As you should.
But the sheer volume of external validation they highlight is remarkable.
It really moves it beyond just marketing talk. They specifically mention earning 13 Best Bank Awards across small business and middle market categories.
And the key part for me was that these awards were specifically for customer service, trust, and valuing long-term relationships.
In a high interest rate environment, those soft measures become financially vital. They really do.
And I found the executive recognition even more surprising. They took the #1 ranking among large-cap banks for the 2025 All-America Executive Team.
A clean sweep, basically.
Practically. We're talking best CEO, best CFO, best company board, best ESG program, and best IR program. That kind of external recognition from institutional investors and analysts, it validates their stability. It tells you that the market sees M&T not just as a profitable bank, but as a predictable, high-quality, transparently managed one.
Which has real financial benefit.
Oh, absolutely.
Yeah.
That reputation feeds directly into lower capital requirements and, crucially, access to lower-cost funding. This relationship focus isn't a cost center. It's a competitive advantage. And we'll see that play out dramatically later when we talk about their deposits.
Okay, let's zoom in on Q4 2025 then, because this is where the picture gets a little more complicated. The full year was fantastic, but Q4 diluted EPS came in at $4.67,
All right.
which is a great 21% jump year over year, but it was a slight drop from the $4.82 they posted in Q3. If you're just a quick scan investor, that quarter-over-quarter dip is a red flag.
It is. So we need to figure out what caused that softness.
Where do we start?
If we follow the money, we have to start with net interest income, or NII. And on the interest side of things, it was actually pretty healthy. NII increased $17 million, or 1%, quarter over quarter.
Okay, so that's a positive.
It is. And it drove a marginal 1 basis point increase in the net interest margin, nudging it up to 3.69%.
A 1 BPS gain is small, but any gain in M in this environment is a win, right?
Yeah.
What were the components driving that?
Well, the net effect was positive, but it was a bit of a battle. They successfully managed their assets and liabilities, gaining 4 basis points from a net higher spread.
That's good management.
Very. They also cleaned up some hedging instruments, reducing the negative impact from interest rate swaps by another 3 basis points. However,
There's the other side.
right, they lost 6 basis points due to a lower contribution from net interest-free funds. This happens when, certain non-interest-bearing deposits shift around. The key takeaway, though, is they successfully squeezed a little more profitability out of their core assets this quarter, despite those pressures.
So if the interest income side was actually strong, that means the entire quarter-over-quarter dip must be because of non-interest income.
You got it.
That number fell 7% quarter-over-quarter, down to $696 million.
Absolutely. This is the crucial analytic nugget for Q4. The revenue decline was not because of a core business slowdown. It was because of non-recurring one-time income that inflated Q3's results and simply did not repeat.
Okay, can you break down those non-recurring items? Because a 7% drop is significant.
It is, but look at the items that just vanished. In Q3, they recognized a $28 million earnout payment related to the 2023 sale of the CIT business.
That's a huge non-operational windfall.
Huge. They also received a $20 million distribution from an investment in BLG and another $12 million gain on the sale of equipment leases.
So you add those up.
And you've accounted for the bulk of that Q4 revenue contraction right there.
Wow. So if we strip out over $60 million in one-time gains from Q3, the core revenue generation in Q4 actually looks remarkably stable, maybe even stronger.
It completely reframes that slight EPS dip. It
Yeah.
does. And the internal growth backs that up. Look at mortgage banking revenues. They actually increased $8 million, or 5% quarter over quarter.
Interesting.
Also up by about $3 million, largely from their global capital markets business. So the recurring revenue streams are healthy.
Let's pivot to non-interest expenses. They were also up slightly, 1% quarter over quarter, even as the bank was tightening its belt in some areas. It seems like the swings in expenses were pulling in opposite directions.
They were, and some of the decreases were a major win for them. Salaries and employee benefits decreased by $24 million. That reflects lower severance costs, which is good for the long term.
And what about this FDIC line?
This is a massive regulatory win. FDIC assessments decreased by $21 million.
$21 million. Why did that fall so much?
That benefit reflects reductions in their estimated special assessment expense. Basically, the FDIC is adjusting its loss expectations from those failed banks back in 2023, and M&T is getting the benefit of those lower loss estimates. It's found money, essentially.
That's fantastic, but those decreases were offset by increases, right? Professional and other services rose $24 million.
I assume that's legal and review costs.
And there's this fascinating $30 million item that jumped out at me in other costs of operations.
That's the most interesting expense line this quarter, because it directly links back to that corporate identity we talked about. Other costs of operations increased $15 million overall, but that was driven primarily by a very large, non-routine $30 million contribution to the M&T Charitable Foundation.
Hey, wait, so they chose to take an intentional, voluntary $30 million hit to their Q4 profit and loss statement just to support their community image and their foundation work.
That's exactly right.
That's a bold move. It certainly supports the narrative of being a bank for communities.
It is intentional. When you look at the Q4 financial picture, they were cleaning up non-recurring income from Q3, dealing with high legal costs, and then they layered on a massive philanthropic expense. It explains a huge chunk of the softness, but it reinforces that their community spending is not just incidental. It's a planned operational priority.
Even if it hits the bottom line temporarily.
Even then. Now, moving from the income statement to the balance sheet, the bank remains incredibly stable.
How are capital levels?
Strong. Their estimated CET1 capital ratio, which is the core measure of a bank's ability to absorb unexpected losses, was at 10.84% at the end of the year.
Solid.
And management showed confidence in their own valuation by repurchasing $507 million of common shares during Q4.
And their funding picture looks extremely favorable, which brings us back to that relationship model we talked about. It does. Average deposits increased $2.4 billion quarter over quarter, hitting $165.1 billion. But the real structural advantage here is the cost of those funds.
Ah, okay. What's the story there?
The average interest-bearing deposit cost decreased significantly by a massive 19 basis points, falling to 2.17%.
19 basis points. That is the direct, tangible financial benefit of being a long-term, relationship-focused bank, isn't it?
It is. Their stickier, community-based deposits are just less sensitive to rising interest rates than wholesale or institutional funding. This 19 BPs drop dramatically lowers their overall funding expense and supports that expanded NIM we discussed. That is the M&T magic in action, paying dividends right to the P&L. Now let's look at the asset side. Loans. Overall, average loans increased by about $1.1 billion. Where was the growth concentrated?
It was pretty solid, diversified growth. Residential real estate loans were up 2%.
Okay.
Consumer loans increased 1%. Mostly driven by recreational finance and home equity lines. And commercial and industrial loans, which often signals business confidence, also grew 1%.
So core lending is healthy. But what about commercial real estate? That's been a pressure point for a lot of regional banks.
Commercial real estate, or CRE, continued to contract by 1% in the quarter, which M&T says is primarily due to just natural payoffs. That contraction, however, connects directly to their credit quality indicators, which are crucial.
Okay, so how is the credit health overall? It's always the first thing you look for when analyzing bank earnings in a tightening environment.
Overall, the trend is positive, suggesting some very active risk management. Non-accrual loans. That's loans where payments are significantly past due declined 20 basis points QOQ and 35 basis points year over year.
That's a great trend.
It is. And criticized loans decreased substantially, dropping a major $518 million in just the quarter.
$518 million. That's a huge cleanup in one quarter. Does that mean they took big losses, or were these successful loan workouts?
That's the tension we need to explore. The largest decrease in those criticized loans came directly from commercial real estate. Permanent CRE dropped $324 million, and construction was down $105 million.
So they're tackling the problem area head-on.
Aggressively. But here's the nuance that suggests successful management rather than panic losses. 94% of those loans that are still categorized as criticized are actually current.
Meaning the borrowers are still paying on time.
Exactly. The bank is being proactive in classifying the risk, but the underlying payment performance is stable.
That context is vital, but you did mention one metric that showed some pressure.
Yes. The single storm cloud on this otherwise clear horizon is the net charge-off ratio. This is the measure of loans written off as losses minus any recoveries.
And that went up.
It did. That ratio increased quarter over quarter, rising from 0.42% in Q3 up to 0.54% in Q4.
So even while they are actively cleaning up the criticized loan book, the macro pressure is still bleeding through in the form of actual losses. That 12 BPs increase warrants attention.
It does. It confirms the environment remains difficult. It shows that active trade-off. They're managing the overall risk exposure successfully, but they are not immune to general economic pressures, causing more defaults in specific smaller segments.
Got it. And finally, let's just touch on their specialized lending, specifically their exposure to non-depository financial institutions, or NDFI. That can be volatile.
M&T appears to have managed this risk pretty thoughtfully. Their NDFI exposure is 9% of total loans, which is lower than the peer median of 12%.
And the quality.
Crucially, the quality of that 9% is what matters. It's concentrated in lower loss profile areas.
Right.
Institutional CRE credit solutions, residential mortgage warehouse lines, and private equity subscription lines. M&T views these as high-quality specialized relationships, which mitigates the volatility you often see in the NDFI segment.
Okay, let's unpack this for you. What are the key takeaways from this deep dive? 2025 was defined by strong financial growth.
Supported by textbook interest management and clear operational efficiency improvements.
Yeah, and Q4, while showing that slight quarter-over-quarter dip in the headline EPS, was primarily a story of financial cleanup and really strategic investment.
It was. They successfully navigated the exit of those large, non-recurring Q3 income items, and they intentionally invested $30 million into their charitable foundation, reinforcing their core brand identity.
And the balance sheet is strong.
Very. Capital is high. They reduced criticized assets. and they leverage that community model to secure significantly lower deposit costs.
But the number we need to keep watching is that uptick in the net charge-off ratio in the fourth quarter. It's a reminder that while management is performing brilliantly on internal controls, the external environment is still placing stress on parts of the loan portfolio.
Absolutely. And that raises an important question for you to mull over as we move into 2026. M&T has proven its ability to generate capital and clean up criticized commercial real estate assets. But their biggest competitive advantage is that historically low-cost deposit base, secured by their relationship banking model.
Right.
As competition inevitably heats up for every single dollar of deposits in 2026, how will M&T balance maintaining those high standards for customer service, which is key to those sticky deposits, with the fierce pressure to maintain their stellar efficiency and profitability metrics? That ability to keep their identity and their financials aligned, that will be the true test going forward.
A compelling challenge. Thank you for joining us for this deep dive into M&T's latest results.